Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey folks, welcome back. Today our special guest zooming in from Michigan, David Kamara, is a very experienced real estate investor. He's got him in that sweet spot. He's in multifamily, but he's not going after the real mom and pop deals. He's not competing with the big institutional guys. He's kind of got that Goldilocks formula of going after the right size property in his backyard. So David, welcome to the show. Great to have you.
Thank you so much, Dave. I'm thrilled to be on your show.
Yeah. So David, give us a little snapshot of what Cape Sierra Capital looks like as of the middle of 2026. Like what's your buy box and what does the portfolio currently consist of?
Sure. We look for cash flowing properties in Michigan. Our buy box is really anything $40 and up, and we tend to stick below $250.
Okay.
We currently own just about 1,200 apartments in Michigan.
How many different communities, David?
I'd say about 15 or so.
15? Okay. Yeah.
Yeah, we're currently under contract. We're looking at a deal, 84 units, about an hour and a half from where I'm sitting right now.
Okay.
So yeah, that's kind of what we tend to look for. It's, since post-COVID and interest rates increasing and now kind of coming down to earth a little bit, it's been a bit of a roller coaster for what you can find, but we usually look for a good ratio of cost per door to rent per door.
Yeah. So Michigan's a fairly large state. How much of it are you covering?
Quite a bit, actually.
Yeah.
We own all the way up to Marquette in the Upper Peninsula on Lake Superior, and all the way down here to southeast Michigan, where I live. I live in Ann Arbor, home of University of Michigan. And then we have things, around Grand Rapids, around Kalamazoo, and anywhere and everywhere in between.
Do you keep management in-house or do you use third-party management?
Early on in our trajectory, I was very fortunate to find a property manager that became a very good partner. Mm. And specifically how that came about was we had a fire on one of our deals, and I was literally pulling away from the shore going on a cruise when this fire broke out.
Wow.
So I couldn't really leave helicopter over there or anything, but they did a really good job taking care of the property and really not overcharging us. And since that point, we have actually given them an equity stake in each deal we do. And so that has been a very good partnership for us. So
that's pretty smart. So they're statewide, I guess.
Correct. Right? They enable us to buy as far away as we are. So Marquette's about a 7-hour drive from where I am in Ann Arbor. But they do have operations across the state. They manage about 7,000 apartments. And they definitely have become a partner. So back to your original question, we don't have property management in-house, but we sort of kind of do.
Well, that's really, really interesting, David. So walk me through, if you don't mind, how do you structure the equity with the property management company? Like, what does that typically look like? Let's say, for example, the project you're looking at closing now.
Yeah.
I imagine you're going to do the same thing with these guys. What's that typically going to look like from their end as far as percentage?
Yeah, so usually our LP GP splits are 70-30. And then within that 30, they get a portion, right? Okay. And I'd leave it at that. I'm not going to
No, that's okay.
Further, but that's essentially how it works. So it's a meaningful enough chunk where they get to build equity on top of their success. They get to earn their regular property management fees, but they do assist us in due diligence, for example. They'll often assist us in the strategy for what we can do with the asset based on capabilities, based on the area it's in. And they've also been very strategic in actually bringing some deals to us, and that because they manage so much, they often will hear about deals that are coming up for sale. And they will say, this deal looks great on paper, but honestly, there's not any meat on the bone there to go get. It's going to be a difficult deal, or it's on the wrong side of the tracks here. Let's not venture there. It's just a high risk, high reward proposition. And they also invest with us on the LP side. So the way we structure is KPCR invests in each deal we do our own equity. And as of late, our property management company has also invested with us as an LP as well.
So they're triple dipping.
Sure. However you
No,
describe
it's
alignment,
really, I think it's
whatever makes
brilliant.
alignment happen is what we are trying to accomplish.
Yeah. So, David, did you see somebody else doing that kind of partnership with their property manager? Did they suggest it? Did it just come to you in a moment of inspiration? How did you kind of come up with that idea? Because that's
I didn't see anybody else doing it, honestly. It did come to me in a moment of inspiration after all the headaches of managing reconstruction and managing insurance on a fire where we lost 12 units. And I mean, honestly, they were a very good partner, right? They were very transparent. They're like, hey, here's what this is costing. Here's what we're putting into it. Here's the insurance fees and overhead and all that. And this happened right before COVID. So we ended up having to rebuild through COVID, which had its own challenges. And so I wanted to be fair, and I wanted to, again, further align our success with their success. At the time, we were much smaller. We had the unit count we had was in the hundreds of units, and they were managing things in the thousands of units. So a little bit of it was, if you are with a property manager that manages a ton and you're a very small fish in a big pond, you kind of, I wouldn't say this was ever the case, but I wanted to make sure that we got the attention we needed when we needed it. And they were giving it to us, but I also wanted to make sure that there was even further alignment than just them doing the right thing, consistently going forward. And so again, I mean, I don't think it was, quote, charity or anything. I mean, it was just a good business decision that's frankly paid off. And so, I mean, today when we look at deals, we're very much, I mean, we work as partners. They will advise. They will give us their very honest opinion about where things are and how things would go, and I value that a lot. And I mean, it frankly has resulted in I would say a higher than average success rate for our investors because property management is indeed aligned, and they're not just getting a fee. Property management, I think, is very misunderstood. It's a very difficult business, right? You're trying to do a lot with often not the best, quote, in parentheses, talent, right? Where I mean, a lot of folks are working on an hourly basis. Some people are salaried, but it's tough to get, I would say, your, for lack of a better word, Wall Street talent to go do property management.
Yeah.
Just because it's a headache. You have to deal with the population and people in general who will disappoint you. And so it's a tough business. And then on top of that, right, property management just gets often blamed for when things go wrong, and frankly, it doesn't get rewarded much for it.
It's a fairly thankless job from what I can see, for sure. Well, you know what, David, I think that is really, really smart because I've interviewed a lot of operators, and at some point they get frustrated with their third-party management and they go through a few different ones, and then they end up bringing it in-house and going vertically integrated, and then that's a whole new business themselves. So you are kind of vertically integrated. These guys, they aren't your staff, but they are your partners much more than just being a third-party management company. Right. I'm sure you still keep tabs on things and everything like that, but you've gone from being a very small fish in their pond of clients to just by door count, now you're one of their probably top clients with over, I think you said 1,200 doors in the portfolio. Yeah. They're partners with you on that. So you've got the property management company's owner's ear. If something comes up, you're not just talking to an underling.
Absolutely.
And because they're so incentivized, I'm sure they're putting the best staff they have on your deals. So hats off to you, my friend. That was a very, very good moment of inspiration. So getting back to the portfolio, you focus on Michigan. You're kind of all over the state. What kind of properties are they? Like what class of properties, what class of tenants are you looking for? What's the exit strategy? What does that side of the business look like?
Yeah, so we are focused on B and C class assets, trying to get C class assets to be B assets. Um, and I think, I mean, for us, we're trying to return an average annual return to investors of about 15% or higher. That is difficult to do with Class A assets, in my experience, just because you're paying because it's a newer property. And with the assets we look at, you can't always accomplish that either. So we're very selective. We don't do any deal. Um, when I started, my wife and I used to live in Chicago, and our first property, which was just me and her, was a duplex and a threeplex in Gary, Indiana. And I mean, Gary, Indiana used to be a good place, but it's just kind of the city has deteriorated.
Hmm.
Uh, Home of Michael Jackson, interestingly. But one of the things my wife said to me was, "Hey, you need to come home at night. I don't want you going there when it's dark because it's not a neighborhood I trust." And
Yeah.
so ever since then, and we've since sold that a long time ago and learned many lessons there. The goal has always been to own assets in a place where I would feel comfortable being at night and where, kids can play in the neighborhood. And I mean, sure, we'll make things better, but we don't venture into
Yeah,
dangerous,
you can't
dangerous
necessarily
places.
fix the whole neighborhood, right?
Correct. We don't venture into dangerous neighborhoods.
Okay.
Our property managers need to be safe. Everybody needs to get home. And I mean, you can get aggressive and corrosive tenants in all asset classes, but we stick to, like I said, B and C neighborhoods, B and C type assets, and try to get them to the next level up.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
What's the exit plan for your property? What's your strategy there?
Sure. The business started. So I used to be a management consultant, and in that capacity, I traveled a ton. I basically traveled 4 days a week, almost 50 weeks a year sometimes.
No.
And so when I transitioned to doing this, the goal really was not to build a syndication business. The goal was to get me to be home more and stay and be able to watch my kids grow up and attend their sporting events. So the exit strategy differs based on what we're doing, right? So for assets that I own myself without any investors, the strategy is to operate them well, increase value, at some point refinance, and then buy more things. For assets that we buy with investors, I'm fortunate enough that all of my investor network is not usually itching for an exit. This is a long-term value build strategy for them that's diversified from the stock market on a day like today when, there's a rotation out of tech, right? And there's a spike in oil prices in the Middle East. Some people just want something that is not correlated with that, right? And it's
Something a little more steady Eddie, huh?
steady Eddie, but also you just never know, right? You just want to not be all eggs in one basket, so to speak. So on our investments with investors, which is the majority of what we do, if the property indeed cash flows so well and exceeds our expectations, which happens often, we're very upfront. Like, hey, if this thing is cash flowing at, say, 9, 10% and more a year, do we really want to sell in 5 years or 6 years or 7 years? Like, what are we going to buy? Like, where will we put our money? Most of our investors are patient capital. And if it makes sense, they're like, yeah, let's just hold on, right? Like we know that the property is appreciating, the cash flow is good. Let's just keep going. If for whatever reason things aren't performing as expected, which happens with all investments, then we'll consider like, hey, we said we're going to sell in 5 years. It's year 4. Do we want to exit this and go look for something better? Or do we truly believe as the management team that, yeah, it hasn't performed that well, but there are very understood and well-known reasons why, and we think this still has legs, and let's perhaps keep going. So we have a conversation with investors, and we make a decision that way.
Well, sometimes it can kind of be like herding cats with investors, and you've got different people with different goals and whatnot. So, when are you syndicating your properties, and if so, like typically, how many investors do you have in a normal deal?
Yeah, we do syndicate. I'd say our investor number ranges between 20 and 50 per
Yeah.
deal.
So even on the low side of 20 people, that's a lot of different personalities and desires and whatnot. Is it kind of a majority rules kind of thing, or how do you do it? Because it sounds to me like you're a patient capital kind of guy. Like you want to, it's a lot of work finding good deals, getting them
Right,
up and going and selling them. It's kind of like,
right.
so when you are in that situation where you'd like to extend it and not sell it at 5 years, how do you get most of your investors on board with that? And what do you do with the ones that aren't?
Sure. So typically, people tend to kind of lean the same direction, but of course, yes, everyone has a difference in their personal situation, etc. I'm in a, I guess, unique position where I can buy somebody out of their
Okay.
portion. And our investment documents are structured that way. They are definitely structured to incentivize you to hold through the original prescribed hold term. So
Right.
there's a bit of a disincentive to exit early. But there have been, I think there's been one case where somebody said, hey, my situation's changed and here's what's happening. And again, I think the beauty of our company is I know most of these folks personally,
Mhm.
or have had some kind of a working relationship with them, either in my previous work or through personal circles. And so it's not really too much of a hardship to go and, either buy that person's shares. Because again, I like doing the deals that I feel comfortable putting my own money in.
Yeah.
The way our documents are structured is the GPs get the right of first refusal. If they don't or are not in a liquid enough position, it goes to all of the LPs. If nobody is interested or is in that situation or position, then it goes to the entity itself. So if the entity has cash, it can buy back
Okay.
shares, and essentially there's a reverse dilution effect where everybody gets a bit more equity per se in the deal. And finally, if that's not true, the investor can find somebody to take their place. However, the GP has to approve that
Got it.
it's
Yeah.
a participant that we would like to be part of the entity. So I mean, I don't think that's too different from what most do, but we thought
No,
that
no,
that
I was just wondering, not so much during the initial 5 years. That's fairly common. It's like if you get to year five and the original deal was we're going to sell at year five and you don't want to sell,
sure.
then what happens at that point?
Yeah, so I don't think we've had that situation yet. But I guess the consideration would be one, we could sell it, right? I mean,
Oh, yeah.
unless I own more than 50% of the deal, which in a few cases I do, but not too many. Um, but then the other option would be if the property has appreciated enough, or we can refinance it and get people their money, and at the same time my portion grows so that I can continue owning it. And in this case, I guess it would be probably myself and the property management team because they would have
Yeah.
good equity share as well. So then we'd make that decision and go from there. But I mean, those are the options. We could be forced
Yeah.
to sell it, and that's okay. Yeah.
Yeah. Makes sense. Excellent. So, David, as we're wrapping up our conversation here, where are you taking the company over the next couple of years? What's your vision?
Yeah. So we are trying to grow in a measured pace. I feel a lot of operators, particularly when the sun shone, kind of got a bit over their skis and did a bit too much. Not to say we didn't have difficult times in our company as well, but in general, we've come out pretty well through this whole interest rate hike and all of that. So we want to do 2 to 4 deals a year. We want to slowly grow our investor base. We want to make sure we return good returns to investors and continue to build trust. I speak to many investors who are like, "Hey, this is something I really love to do, would like to do, but the timing is not right." And for us, I mean, this is a multi-year, frankly, multi-decade conversation that may not be right today, may not be right in 2 years. People are taking care of their parents, people are taking care of their kids, careers change. This is more of an educational path to let people know that there's something other than just putting your money in Wall Street, and diversify, try a bit, see if you like it, and you may not like it. It may not be for you. But yeah, we're just trying to grow slowly. That's the vision.
Okay, very good. And who are you looking to connect with these days, David?
I'm looking to, I guess, attract young professionals that are maybe even very early on in their career and understand that this is an option for them, maybe now or in the near future. Most of our investors are, again, doctors, lawyers, professionals in various fields, engineers. My background is in computer science. A lot of consultants invest with me. Just really looking to grow that audience a little bit. People that are very analytical, right? Will ask me tough questions. Honestly, a lot of the improvements to our company come from investors asking good questions and saying, "Hey, have you considered this?" Or "Why are we doing this way?" So yeah, I'd like people that challenge us and have good ideas, and at the same time understand their lane and they're passive. We're active. Uh, those are the kinds of individuals we're looking to connect with and attract.
Very good. So if some of those people are listening to this and they say that David Kamara guy sounds pretty smart, I'd like to connect with him, how can they do that?
The best way to reach us is on our website, which is capesierracapital.com. You could also find me on LinkedIn, but Cape Sierra Capital will get to me just fine. Just that's the best way.
Perfect. David, congratulations. Thanks for sharing that whole strategy that you developed working with your property management company as a true equity partner. I think that's brilliant. And congratulations on your success, and I'm sure it will continue.
Thank you so much, Dave. I really enjoyed being on your show. Thank you.
All right, everybody. Thanks for tuning in. We'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.